Well, welcome to Investing for the Future on a Limited Budget. I'm Jon Nash. I'm one of the course directors in entertainment business here at Full Sail. And I want to show you some very simple steps to get your money to work for you. How many in here are excited about that? I want to say a special welcome to all those that are watching online, all those that will watch this later on. This is a presentation that can literally change your life. And I mean that. I recognize that some of you have already invested. And my hope for you is that you'll take away at least one thing that will tell you where you've been, where you are today, but more importantly, what you need to do next. Perhaps the rest of you maybe haven't invested at all. And I believe that this will be an important step that will position you for success. These are principles that are fairly basic, but yet we as a country have a long way to go to reach these ideals. And all of us can be reminded of the basics of investing. So I want to take you on a little journey in this session that will put you in a position to reach some important goals, okay? So let's get started. First, a little disclaimer. I am presenting this class as a professor at Full Sail, not as an expert. No specific investment advice or recommendations are being made. And as always, consult a professional before making any important money decisions. Secondly, we very much appreciate the permission that ABC has given us to air a couple of clips that you'll see in classrooms like these at Full Sail. And we also respect their request not to rebroadcast. I was thinking about what kind of a textbook we should start in this session to draw from, and where I can get some principles to look at. And I went to a bookstore and I came across this book, Investing for Dummies. Great book, great principles. But you know what? A couple of steps away, over on this side of the bookshelf, was another one that I thought was 10 times better. Investing for incredible Full Sail students and faculty. And that is where I drew my material from. So here's where we're going to start. Let's start with the big picture. Let's talk about America. How do you think America is doing overall with saving and investing? Not too good. Not too good. As a matter of fact, there was a study done recently by the National Bureau of Economic Research. And that study showed that nearly 50% of Americans could not come up with $2,000 for an emergency. Now that's about half the country, and it's only $2,000, and that includes all sources, including family and friends. Now, what does that say about where we are as a nation? And you have to begin to ask yourself, why? Why is this? Well, it's fairly simple. Let me put it this way. Many times, we confuse two things, needs and wants. Does that make sense? Things that we think are needs aren't always needs. They're sometimes wants. And because of that, we place investing on the back burner. Well, I'll invest when I have the money left over. Well, I'll do that later. But investing has to become a priority. Listen to this. According to Business Insider, Americans spent $59 billion in 2010 on lottery tickets, $44 billion on tobacco, and $69 billion in casinos, just to name a few things. But one thing is very clear. Investing is not a want. Investing is a need. And I hope by the end of this presentation that this will resonate with you. And because of these principles, if you put them into practice, you can reach some of your important goals. And you can have a lifetime of rewarding experiences. So let's define investing, first of all. What is investing? Investing is putting your money to work for you so you can reach important goals. It's very simple. You have some goals, you want to reach your goals. Investing is what you do to reach those goals. But there's a little bit of a science to it, and that's what the rest of the presentation will show you, some of the basic steps to get there. One thing that's important to understand is that all money has a purpose. If money has a purpose for you, then you can reach a goal with it. But if it has no purpose, then it will get spent. That doesn't mean it all has the same purpose. But if this part of your money has one purpose, and this part of your money has another purpose, and this part another purpose, you can use these buckets of money to reach an important goal down the road. Whether it's 2 years out, 10 years, 15 years, or 40 years, doesn't matter. It's the same principle. Money has to have purpose in your life. So let's talk about some of the common purposes for money. How about buying a car? How about investing for retirement? How many would love to have a lot of money for retirement? How about a down payment on a home? That's another common goal that people have. And for those of you that are a little bit older, putting a down payment on a house. That's another common purpose for money. But your goals have to be very measurable if you want to reach them. For example, by age 23, I want to save $5,000 for a car. By age 28, I want to save $20,000 to put down on a house, because you need a down payment, right? And by age 70, I want to save $1 million for retirement, or $5 million, or whatever your number is. How many know $1 million isn't $1 million anymore, right? So you got to kind of move it up a little bit. Maybe it's 2, maybe it's 5. If you're investing, though, you need to have an investment process. So let's talk about that. Here's a very simple set of elements of an investment process. First of all, setting your goals, assessing your level of risk, then selecting the investments that make sense with that, and finally, coming back sometime later, whether it's 6 months or a year or a couple of years, depending on your personality, to monitor those investments to see how they're doing, because you might need to change something. So this is the basic process that we go through. Now, there is an enemy that all investors face. To the extent that you understand this enemy, then you can make wise investment decisions. How many have noticed that gas prices tend to go up, but rarely ever go down? Is this true? Now, I want a little bit of feedback from the audience here, so a few volunteers here. I want you to think back to what is the earliest price of gas that you can think of? 98 cents. Excellent. Wow. Now, is that because you lived in Texas, or is that because it's just that? Lucky guess. They were ridiculously low, weren't they? Anybody else? What's the lowest gas price you can? $1.80. What was that? 93. Wow. Okay. Some great answers. What is it today? And how about in your home state? Anybody from California? $4.75. That is intense. 5:15. Yeah, that was an amazing time. And of course, every state's a little different. But as you can see, they're now charging an arm and a leg for gas. So you need to be careful out there. So drive a smart car, okay? Right? Okay, so what am I talking about? What's the enemy that all investors face? Inflation. That's right. Inflation is a continuing rise in the level of prices in the economy. And most people think that prices are rising, but to take from economics, what is really taking place is that the money value is going down. The value of your money is declining, and has declined some 80–90% since the Federal Reserve was formed. Thankfully, inflation is very low right now, but the average has been a little higher than it is now. So over the long term, from 1913 to 2013, inflation has averaged about 3.2%. Right now it's lower than that, but we very well could return to the long-term average in the next several years. So investing is putting money to work to reach important goals, but inflation is the #1 enemy. What does that mean? That means that if you're investing money for important goals, then by the time you get to those goals and take the money out and to spend it, what do you think's happened? It's not worth what it was, or it's not worth what it says it is. The dollar amount that you're looking at when you take it out is not going to buy as much milk or eggs or cars or whatever else. It's not going to buy the same amount of goods and services. And so understanding this changes your entire outlook on investing. And one of the reasons is because, let's talk about it very frankly, a savings account. Is a savings account paying a lot of money? So, do you think a savings account is a suitable place to invest for goals longer than a few years? Probably not. Now, if you're going to spend money in the next 4 months or 6 months or a year, maybe a savings account is okay. But beyond a certain time frame, you need some other types of investments, and that's what we're going to talk about next. We're going to keep it fairly simple in this session, and there are other types than what we'll talk about, but we'll talk about stocks, bonds, and mutual funds. And I'm not necessarily the best person to introduce this topic. So I'm going to, if you give me a second here, I'm going to have a special guest join us. All right. Thank you for your patience. Was working fine before, so give me a quick second here. I have a special guest that has been waiting quite a while to join you, and they're trying to resist my phone call here. Welcome. I want you to be introduced to stocks and bonds this way.
Okay, let's see if they're ready.
She's got this big tattoo.
Hey guys.
Melody, so what's poppin', babe?
I'm so glad you could take some time for me today. I've got to do this presentation on stocks versus bonds, and I'm really curious about how you guys would explain it.
Totally pleasure. You know, it's funny. I think the last time we saw each other was at that. I think you were so pretty. Big brown eyes.
Well, thank you, Benny. That's very, very sweet.
She knows my name.
Okay, why don't you start by telling me what is a stock?
All right, check it. A stock is a share in a company. Yeah, a stock is a share in a company. Glad that's cleared up. So anyway, you buy a stock in a company, and that it pretty much means you're part owner of it.
Like one car and a big choo-choo train set?
Well, what is this, Melody? How old do you think I am?
Wait, I've got your bio here. It says you're 14 and a half months old. Is that right?
Oh, snaps.
Okay. Why don't we move on?
Well, here's the thing. I mean, it's all about buying and selling the right stocks at the right time.
What do you mean by that? Elaborate.
Okay, let's say, for instance, my friend Benny here was a company, and I bought his stock this morning when he wasn't being quite so humiliating. I'm not about to go sell it now because the value of his stock has dropped significantly in this interview alone.
Benny, what do you have to say about your stock?
My stock, I just, sleep through it, and, I wear the sweater vest, for you. Do you like it? You don't have to answer that, Melody.
Okay, let's move on again. How about bonds?
Oh, well, how about them? I'm just kidding. Buying a corporate bond means you're loaning a company money for, a certain amount of time. I don't know, 3, 5, maybe 8 years. It's kind of like a fancy IOU.
Okay, how do you make money?
You only pay interest on your loan.
And when the time is up?
Oh, man, you're relentless, huh? When the bond matures, they pay you back your coin.
Well said, and I was really just thinking...
Here you go. Can I get your back? No, you can't find them because they're not in season right now. Just squeeze them. Squeeze them, and if they're soft, they're too late. We'll just talk about it later. All right, call you back. Well, sorry about that. You were saying?
Well, what I was going to say was thank you for making time for me today. You gave me some really great ideas. Benny, I'm really sorry I didn't get to you.
No.
Thanks.
So, as you can see, stocks give you an ownership in a company. But guess what? Buying a stock does not give you any promise to get your money back, does it? But it does give you the potential to earn a significant return, right? Buy the wrong stock, you can lose all your money, right? What's the downside? What's the maximum you can lose on a stock? Everything, right? But what's the upside? Is there an upside? Is there a maximum? Okay, so a stock is an ownership claim on the company with no promise of repayment. And your hope, of course, is that the company that you invest in generates quarterly earnings that continue to increase over time. The only problem is that it never happens in a straight line, does it? So you have to understand that stocks go in cycles. And in the short term, the stock market is highly volatile. It's basically like gambling. Now, unless you're a trained day trader, you've gone to day trading school, and you want to be glued to a screen all day long and never move your eyes away, for the rest of us, investing in stocks over the short term is a lot like gambling. But that doesn't mean we should ignore them. Let's talk about bonds. Bonds, when you buy them, are technically loans. You're loaning someone money with the promise of a repayment of that loan. The money that you loan them is called the face value. What do you get in return for that? Anybody know? You get what you paid for back But what happens along the way? You said the word, you get interest. So just like if you went to the bank and you got a certificate of deposit for 1 year, it's going to pay you interest. Just like you get a savings account, it pays you a little bit of interest, right? A bond pays you interest over time. They're promising to pay you this interest, which we call the coupon rate on the bond, and eventually the whole amount of the money that you invested at the end. For example, if you invested $10,000 in a McDonald's bond, McDonald's is going to pay you interest, and then they promise to pay you at the what we call maturity of that bond. Your money is going to come back to you. So bonds are issued by these types of issuers. So we have the U.S. government; they issue bonds all the time. T-bills are an investment that right now aren't paying very great interest rates, right? Treasury bonds are paying a little bit more. But there's also corporate bonds like McDonald's, for example, or ExxonMobil, Verizon. Municipal bonds, what does that mean? Well, that means the municipal government needs money, and so they take money from investors like you and me. If we buy from a municipal bond fund, maybe the state of Florida or the city of San Bernardino, California, or whatever it is, those are municipal bonds. They also have a special tax status, which means that the interest that you earn from those tends to be tax-free depending on your situation. Now, of course, you have to consult a tax professional to see what is going on in the rest of your finances to determine whether you receive that benefit or not. But those municipal bonds are at a tax advantage over other bonds. So if you get a 5% rate, let's say, for a municipal bond, and you have another type of bond that's paying 7%, the 5% municipal bond may actually be a better deal if you factor in the taxes that you have to pay on the higher yielding bond. Does that make sense? And finally, there are foreign governments that issue bonds and foreign companies. So you can buy funds that invest in foreign bonds. So we have stocks, bonds. Another thing about bonds are rated by rating agencies. What does that mean? It's almost like your credit rating. Now, if you go to buy a car, they're going to pull up your credit score, aren't they? They might not show it to you. Maybe they do, maybe they don't. But each of us has a credit score. Guess what? Bonds do as well, especially corporate bonds. So, for example, a bond might be rated AAA. Well, that's the highest that you can get. That means that this is a fairly safe company. This is an issuer of a bond that has a great credit rating. There are bonds that are with BBB ratings, much, much lower on the credit score scale. And these credit ratings don't stay the same necessarily. They can change over time. So if the company is doing very well, they might have a highly rated bond. But if the company is not doing as well, that rating can go down significantly and then come back again later. All right, now here's one of the most important principles of investing. And I'm sure all of you have heard of this, but it's great to remind yourself of this. And that is to not put all of your eggs in one basket. Unless, of course, it's a very, very huge basket like that. No, I'm just kidding. But basically, why do you not put all your eggs in one basket? Because if all your money's in one thing and you have invested everything you have into this one egg, let's say, or one basket, and that investment completely fails, are you going to reach your goals? You have no hope of reaching your goals. So what do we do instead? You guys already know this stuff. So you diversify. You diversify how? Like what? Excellent. So you can invest in multiple stocks. You can also invest in stocks, bonds, real estate, other types of investments. You can build a portfolio, is what we call it, that represents many different kinds of investments. And guess what? When one investment is doing well, another one might not be doing so well. But as you just said so wisely, when one investment isn't doing well, the others can average it out. What we mean by that, and what the benefit of diversification really is for you, is that when you diversify by asset class, stocks, bonds, cash, real estate, then what do you think happens to your risk? It goes down. The more diversified you are, the lower the risk is going to be. So don't put all your eggs in one basket. And this brings us to our next concept, which is that instead of buying an individual stock like McDonald's or Apple, how many people, anybody in the room bought some Apple stock? So Apple's a great company, isn't it? But sometimes the companies go down in value. So buy a mutual fund instead. A mutual fund may have Apple in it, but it may have 50, 100, or even thousands of other stocks in that fund. Basically, a mutual fund is a collection of stocks, bonds, and other securities that investors own collectively. That means that if you buy a mutual fund, then you own it collectively with the other investors in that fund. You all have a piece of that fund. And that means that whatever that fund is investing in, whether it's Apple, whether it's Samsung, or whether it's ExxonMobil, or whatever it is, you own a piece of that, which means you own a little bit of the Apple, a little bit of the Samsung, a little bit of everything in there. And now you're diversified. And this is one of the easiest investments to start with. So if you're looking to start investing, this is probably one of the best ways to go. Why is that? That's because if every time you buy a stock, you have to pay what? A commission. So you buy a stock, you have to pay a commission. And these commissions can add up to a large sum if you want to diversify, because I just told you that you shouldn't buy one investment, right? So if you're going to buy stocks, then you should have at least 5 or 10, right? And experts sometimes recommend even more. If you were to buy 5, 10, 15, or 20 stocks, you'd have to pay commissions on every single one of those trades. And that's the commissions that you pay will eat into the profit potential that you could make. Does that make sense? But a mutual fund has internal fees, but it's much larger. So the fees are smaller on a, when you're comparing it to buying stocks. In the mutual fund world, you can diversify by asset class. They have stock funds. And within the area of stock funds, they have growth stock funds. They have value stock funds. In other words, they have different objectives. The growth stock funds are the ones that are with the higher risk, right? And the value stock funds are the ones that have not so much growth potential, but they tend to pay a higher dividend. In other words, they have some income coming in from them. The stocks are paying 1, 2, 3, 4, or 5% a dividend, depending on what the stock is. And those are more stable than growth stocks, but they offer less growth potential. They also have bond funds that invest in corporate bonds, for example, with higher yields. Bond funds that invest in their municipal bonds from around the country and pay a tax-free income stream to you. There are also real estate funds. So you don't have to go out and buy an office building or a mall, but you can buy a mutual fund that does have those things in them. And now you have part ownership in the real estate that's inside that mutual fund. I don't know about you, but I've always wanted to own a piece of a mall, a piece of a doctor's office. Anyway, you can do that with some real estate funds. They also have other types of funds like international funds. But they have international funds that are Europe only, in Asia, and emerging markets funds, and also some alternative funds that may focus on things like currencies or futures or commodities. Some of those may tend to be a little bit higher risk. One of the places that mutual funds show up most frequently is inside of a 401k. A 401k is simply a retirement investment sponsored by an employer. Typically, they use mutual funds in a 401k. So an employer will contract with an investment company, and that investment company will give them a list or a menu for employees to choose from of the funds that you have available to you. And you can choose the bond fund. You can choose many times they have what's called a fixed fund, which is a little safer type of bond fund, very stable. But they might have a growth fund or an emerging markets fund. And it's up to you to kind of balance out how much you put in the stock fund, how much you put in the bond fund. But you need to diversify. And again, I have asked a special guest to introduce this and explain this topic to you.
Dude, aren't we supposed to go to that 401k meeting?
More like snow 1K up high. Hi.
We're here to make the 401k presentation.
Oh, okay. Really?
Really?
Thank you.
Go to the 401k meeting. Just go.
Greetings and salutations.
Turnout.
Yeah, hi, everyone. I'm Christian Slater, and this is the lovely Rosario Dawson.
Good morning.
It's great to see so much excitement for retirement planning.
Well, HR sent us here to talk to you about your retirement program, and I'm sure you have a lot of questions. So let's just get started.
I have a question. Are you single?
Great, break the tension. It's a good way to get started. But we really want to talk 401k. So, does anyone have any questions about their retirement program?
Yes, I have a question about my retirement. Christian Slater, will you marry me? Because I'll retire tomorrow. Climb you like a tree. What?
Phew. Oh, thank you very much. Okay, does anyone have a question about their retirement plan that's actually about their retirement plan? Okay, I see where the room is at, so why don't we make a deal? You guys can ask us personal questions, but only if you pair them with 401k questions. Does anyone have any 401k questions?
Okay.
Thank you.
Why is it important to participate in a 401k plan?
Fantastic.
And can we see your abs?
401k is a great investment vehicle because your money goes in before taxes, so it grows much faster.
Okay, next question. Yes.
Why should I put all of my retirement money into a 401k when the stock market has been so crappy lately?
That's a great question.
Very good.
And how do you keep your smile so bright?
Okay. Well, on the first question, retirement investing is a long-term game, and even after this lousy stretch, there is no 20-year period when the stock market has lost money. And the other answer is nothing special. I just brush 3 times a day, floss, 2 minutes, you know.
Yeah, and how much should I put into a 401k annually? And do you think a guy like me could make it in action movies?
No. As for the 401k, you want to max it out if you can afford it, up to $16,500. Plus, a lot of companies, including this one, will match a percentage of your contribution. So that's free money. It's like getting a raise just for signing up. Oh, yeah, right there.
How do you stay so fit? Oh, and how many funds do I need, and how do I choose them?
Well, I don't work out, but I'm just kidding. I try to exercise daily, mix up the routines, because variety is crucial in investing and in exercise. Many companies, including yours, have fund options that will automatically do that for you. Or you can select from a mix of funds yourself.
Hi. Can anyone show us where competence from B is? We're here to explain fire safety in the healthcare plan.
I'll show you.
Excuse me? Please.
I hate it when they show up.
I gotta go too. See ya. Bye. Christian, it's great. Later, guys.
All right. So they did a fantastic job of explaining the 401k process and concepts. Investing into a 401k lowers your taxable income. So it's one of the best things that you can do first, if you are working for an employer that offers one, is to start with the 401k. The next thing we want to talk about is risk versus reward. All right? Every time you invest, you have to take risk. And the more risk you take, what's going to happen? What do you expect if you take a lot of risk? I better get something really good for it, right? Otherwise, why take the risk? So the more risk you take, the more return you should get. So as you see here on the scale, you have cash, bonds, stocks. Stocks are more risky than bonds. Bonds are more risky than money market funds or cash. But each one of us has to decide how much risk we can take. It's nothing that I can tell you. It's nothing that someone else can tell you. Only you can decide what is the level of risk that I can take on my own. You have to assess this for yourself. You have to decide, are you going to be able to sleep at night? How far off is your goal? So these are some of the things that determine how you assess your risk level. There's something also called your investment personality. That's basically, what are you going to be like when the stock market is tanking? That's one way to say it. Another more gentle way of putting it is, when the investment markets are on a downtrend, are you going to be able to sleep at night, or are you going to be very, very worried? And how many know we have both a mind and also some emotions, right? And they've done a lot of studies. And what do you think the studies show about investing? What do you think, Dylan? Yeah, and with respect to the mind and the emotions and the decisions that we make. That's a great point. Do you think that we make better decisions, or we make decisions with our mind more or with our emotions more? So what happens is exactly what he mentioned. Stocks go up and down. in cycles. And this is a cycle of greed and fear. Greed, to quote Gordon Gekko from the Wall Street movie original, or if you've seen Money Never Sleeps. And fear is the opposite of that. So what happens is people love to jump into investments when they're doing well. It's very easy. It's a low risk deal, right? Hey, it looks like it's going up. Why don't I put all my money in there? Hey, you believe it or not, people used to borrow money on their house and invest in the stock market. That sounds kind of crazy, doesn't it? Wasn't so crazy in decades past. I can remember the time in the late 1990s when there was a feeding frenzy in high-tech stocks. I remember the stocks that sometimes would go up 10, 20% in one day. You could get in there, buy a stock, make 25%, sometimes on a really good day, get out. Man, those were the good days. And then along comes March of 2000, and what do you think happens? Those same stocks are down 50, 60%. Man, that's painful. What happens is, when the stocks start going down, investors start getting a little bit anxious. And then they go down a little bit more, and investors start to get some trepidation. And they go down a little bit more, and then fear begins to set in. And finally, when all hell is breaking loose, and on the television, people are going, I can't believe it, the stock market is tanking. What do you think the first thing that the average investor, feels like doing? I'm going to pull my money out. Forget about this retirement thing, I'm pulling my money out. And guess what happens? Once all the selling is done, once everybody that wants to sell has sold, what do you think happens to the stock prices after that? It starts going back up. Now, I don't know about you, but I have decided that it is impossible for me to tell when the bottom of a stock market correction is going to be. It's impossible. You might get lucky. So what happens is, when the people take their investments out and the stock market starts to go back up, then they kind of feel a little bit better, but they're not sure. Well, this might just be temporary. It might go down more again. And when it goes up a little bit more, then they start to get a little bit of relief. They start to feel relieved. Then it goes up a little bit more, and they start to get a little excited. Well, then it starts to go up a little bit more, and then, wow, things are better now. And guess what they do? They put their money back in, and what do you think that they miss? From the bottom to where they put their money in, and from where they got out, they have lost part of their return. And that's exactly why the studies show that the average investor does not earn what the market earns. Not because their investment didn't earn it, but because people are emotional, and they tend to act on emotions. So this goes right back to the goals, right? If you have a long-term goal, and you're investing for retirement, let's say, you need to leave that in there no matter what. Keep putting money in there. And once again, it goes back to the purpose for the investment. If you're investing for a car in 2 years, you're not going to take a lot of risk. If you're investing for retirement, you can take a significant amount of risk if you're younger. And in fact, mathematically speaking, the younger you start, the better you're going to do. Why is that? Anybody know? more time, and what's happening though over time? What gives you that? Why is it? It's not just years. In other words, it's not a linear mathematical equation. It's not just every year is a little bit better, is a little bit better. In finance, there's a concept called compound interest, right? And because of compound interest, you're making money on the money that you already made. Next year, you're making money on the money you made before. You're making more money on the money you earned. It's like it being in a savings account. In year one, you earn 10%. 10%. Huh, what a joke that would be, wouldn't it? Let's say 1%. Okay, you earn 1% after year one. Now, in year two, you're going to earn money on the original investment, but also on the 1% gain that you made from year one. So you're making compound interest. It's interest on interest. And that power is like a snowball going down a mountain. It starts out small and it begins to gather more and more snow. And before you know it, it's now a huge, gigantic snowball that everybody's running for their lives because it's about to come running down. Or if you've ever seen Raiders of the Lost Ark, that big bull that's chasing after him. Just trying to give you some visual entertainment along the way. We have any Raiders of the Lost Ark fans? Okay, couple. It's a classic, come on. All right, so how much risk can we take? Here are some examples. Susie's 18 to 30 years old. Can Susie take more risk or less risk? More risk because of her age. Stan is also 18 to 30 years old, but he just happens to have an investment personality that's not so risky. So Stan can't sleep as well when his investments go up and down. So he's more of a moderate risk type investor. Sam is 50 years old. What do you think Sam should do? Take more or less risk? Why? He has less time to invest. Exactly. So Sam is 50 years old, and Sam is going to retire at, let's say, 65. So 15 years left. If all of his investments go down by 40 or 50%, he doesn't have as long to make up that loss as somebody that has 40 years, right? Sandra is 65 years old. How much risk should she take? Not very much. Why is that? She is basically retired. And that means that she's going to need the money fairly soon. The sooner you need the money, the less risk you should be taking. Make sense? These are very basic principles. But if you follow them and you make a decision based on this tonight, then you will position yourself for greater success in the future. Let's go back to the enemy. I said you had a major enemy, right? What was it? Okay, so let's talk about returns after inflation. So in order to understand your returns, you can't just look at the statement on your investment. If you've invested for 1 year, let's say, and you earn a certain return, you also have to think about what inflation was. So here's an example. Sam's stock returned 10% this year. And inflation just happened to be 3% during the same year. It's a very simple mathematical equation. All we do is subtract inflation from the return. So it's 10% minus 3%. So Sam actually earns 7% after inflation. In what we call real terms, Sam's real return is 7%, which is still a good return, but it's after inflation. Here's another example. Sally's 401k return 8% during the last year, and inflation in the same year was 2%. So what's the after inflation return? 8 minus 2 equals 6, right? Very easy stuff. Billy's bond return is 4%. And yet inflation was 3% that year. So that means that Billy only earned 1%. Okay, that doesn't sound like a lot, does it? All right, that brings me to another point, and that is that stocks are creators and destroyers of wealth. But bonds are a store of wealth. So when you think about those two, you have to think about them differently. They do different things. The bond had a promise to repay, didn't it? But did the stock? No. No promise to repay. And that's why it's a creator or a destroyer, depending on what part of the cycle you're in. If you hold them for the long term, stocks tend to go up over time, and there's never been a 20-year period when they haven't returned positively, giving you a positive return. But a bond is more like a store of wealth. And after inflation, you might get 1, 2, or 3%. But you hopefully won't lose any money. Now, bonds do go up and down in value. What do you think affects that value? The thing that affects bond prices is interest rates in the economy. And what I mean by that is if you already own a bond or a bond fund, and interest rates in the economy go up, then bond prices go in the opposite direction. They will go down. If you own bonds or a bond fund, and interest rates go down, that means that bond prices will go up, and so will the bonds in that mutual fund. So that bond mutual fund will go up in value. So you can actually make money or lose money on bonds. But if you hold them over an entire cycle, the ups and downs don't matter, do they? And if you own an individual bond, all the way through until it's maturing, you'll get your money back. So you get rid of that risk. So we've talked about risk and return. Now let's talk about some very simple principles that you've probably heard before, but it's probably time to think about again. Here's the first one. Pay yourself first. Okay? If you don't make investing a priority and put it first, then it's going to end up being last, and there's not going to be enough money left over to invest. Does that sound right in your experience? Almost every study that's done shows that most people spend, at least in America, it's different in other countries, but in America, most people spend all of their income or more. Of course, only the U.S. government is allowed to get away with continued overspending like that. Individuals have to eventually pay up for that or sell something, pay off debt. But pay yourself first and make it a priority, and you'll always be able to come closer and closer and closer to that goal that you have, whether it's buying a car or put a down payment on a home or saving for retirement or saving for college for your kids. The next thing I want you to think about is how you can get rich slowly. Why do you think I have this picture up here of the fried egg in the pan on there? Because this is your brain on discipline. Most of us are less disciplined when it comes to saving and investing. And the reason we are is because society has continually shown us that the way to create the American dream is to spend, 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 right? Why do the corporations do that? First of all, because they'll make money. But second of all, the secret of our economy is that people have to spend money. And in fact, people have to borrow and spend money to make the economy go up. If people don't spend, the economy doesn't go up. If the economy doesn't go up, people get really scared. And when they get scared, they don't invest. Companies lay workers off. All kinds of things happen. So the government wants you to spend money. Corporate America wants you to spend money. And of course, I'm exempting from this statement the Starbucks that's located on the Full Sail campus. You can spend all the money you want at the Starbucks. Or any of Full Sail's properties that we have, any of our companies that are giving us income. However, we need more discipline in our approach to saving and investing, don't we? And another issue that comes up is the fact that whenever people see the markets going down, like I said before, and like you said to me, they tend to be emotional and want to pull their money out. And when it comes to paying yourself first, if the market is going down and you're not paying yourself first, you're more likely to become very concerned if you're acting emotionally. But the best way to pay yourself first is to invest automatically. That's the secret of getting rich slowly. So what if you don't have the best discipline? Okay, become more disciplined. But let's bypass that entirely by setting up an automatic investment plan. By having money transferred out of your out of your paycheck into your 401k. By having money taken out of your savings account and sent over to a mutual fund company or pulled over from a mutual fund company, which you can do very easily. Some mutual fund companies you can get started for as little as $50 a month or $25 in some cases. Do it automatically. Set it up where you're going to forget about it after a month. And believe me, the money that you have taken out, after 1 or 2 months, what do you think is going to happen psychologically to you? You're going to get used to it. You're going to start building your life around it. It's not easy, maybe in the beginning. It might be a sacrifice depending on how much you're investing, but you're going to have an autopilot program working for you, and you're going to live on the rest of it. And most people find that after 1 or 2 months, it's very, very easy to build their life around the rest of it. And this way, money is working for you so that one day you don't have to work for money. Does that make sense? This is a very important point, and that is that you have to keep a long-term perspective. Now, this is a chart from 2004 to 2013. And what's going on right in the middle of the chart? That's what we call the Great Recession of 2008 and 2009. And boy, was it we call it precipitous decline, amazing fall in stock prices. And if you only saw the chart up to that point, you would tend to be very discouraged. And as a matter of fact, people were very discouraged. But if you looked at the whole chart, and you saw that from that bottom, the stocks began to climb and climb and climb, and now we're near the top again. You get a little bit different perspective. Let's take an even longer term view. This is from 1915 to the present day. Here's 2008 right there. Now compare that to the Great Depression. But what has happened over the entirety of this chart, overall? It looks like it's going up to me. The dollar has lost its value, but inflation has averaged about 3.2%. So here are some returns of different asset classes. For example, small stocks over the long term from 1926 to 2011 is when this was taken. A company called Ibbotson Associates, they did this study and got the average returns. Small stocks returned 12.1% on average. Large company stocks, about 10%. Long-term government bonds, you can expect about 5.5% over the long term. Treasury bills, about 3.6%. And inflation, they say, was about 3%. The other one I showed you was about 3.2%, so very close. Probably around 3% is the number that you should use when you're thinking about inflation. Perhaps one of the best investors there ever was. His name was Ben Franklin. Now, if I said I was going to introduce to you one of the best investors, first thing you'd probably think of, I'm going to say Warren Buffett, right? Or if you're a little bit older, maybe you'd say Peter Lynch, who started the Fidelity Magellan Fund and made Fidelity famous. But I'm not going to do that today. I'm going to mention Ben Franklin. Why is that? Now, it's not because Ben is holding a ghetto blaster. I used to have one of those, by the way. It had a double cassette player, you know. On one side you could play, on the other side you could record. And you could carry it on there and go break dancing. Right? So we used to sneak out at night on the weekends. Shouldn't be telling this story, but we used to sneak out at night and go to the breakdancing club. And those were the days. The music has changed just a little bit, but in that time period, I think they came out with Grandmaster Flash and the Furious Five. His first famous song, I remember that. That was something. That's not what I'm trying to tell you about investing. Ben Franklin was a master investor. He was a very savvy guy. Listen to this. He said, you know this, you've probably heard the saying, a penny saved is a penny earned. But listen to this. He proved that it can actually be worth millions. In Ben Franklin's will, he left the cities of Boston and Philadelphia 1,000 pounds each, roughly the equivalent of $4,000 today. That was way back a long time ago. But listen to this. It isn't the 1,000 pounds that's important. He asked that the funds gather interest over the next 200 years and also be used for loans to young craftsmen to help them get established in their trades. So that's why I'm calling Ben Franklin the master investor. He had a 200-year investment plan. Now that's saying something. And to the extent that you have an investment plan, it can not only change your life, but it can change the lives of other people after you, your family, the family that comes after you, for generation after generation. Think what your children or grandchildren, what their life might be like if you do the things that are prudent to become a good investor yourself. Does that make sense? And it doesn't matter how much you have, it matters that you do something and you start where you're at. So let's talk about something very simple. What $5 a day can do. If you set aside just $5 a day, invested at a 9% return, in 20 years, you'll have $100,000. If you continue saving for 35 years, guess how much money you'll have? About $440,000. And if you save $5 a day from age 22 until 65, you will have a cool $1 million. $5 a day. Start where you're at. You've got to start somewhere. So here's what affects your results. How much you invest and how often, the growth rate of the investments, and how long it has to grow. There comes a point when you need some help. And this is when you talk to a financial advisor. So basically, and very simply, how do you select somebody? Well, I like to think of it this way. If you're selecting a doctor, do you open up the yellow pages? Now, you guys don't use it. You don't even know what yellow pages are, right? A phone look? What is that? Would you ask Siri to find you a financial advisor? I think not. I do not know what that is. But perhaps if you could call me on Tuesday, I will give you an answer. It's like choosing a doctor. If you want a new doctor, you don't go to Siri or the yellow pages. You find somebody that already has a doctor and you ask them for a trusted referral. You find somebody you can trust and you ask them for someone. But there comes a point when you will need a financial advisor because you'll have invested enough money to where you need somebody else to start managing it for you because you'll be doing your thing full time and you want to focus on earning as much money as you can and then let a specialist manage all that so that you don't have to worry about it. Let them worry about it so that you can do what you're good at. Because potentially you could make millions of dollars in the entertainment industry. And if you don't follow the basic rules of investing and you don't get some help with those millions of dollars, that money could dissipate over a matter of years or even months. And it's happened over and over again. So start now before you make your first $1 million. And then when you do, you'll invest it wisely. You'll put yourself, invest first. You'll put yourself first. You will invest, what I say, automatically. You will assess the level of risk that you can tolerate. You will take a moment and think about your own investment personality. How much can I invest and how well will I sleep if the market goes down? You will understand the enemy of inflation and how it works against you so that you need to have at least some of your money in stocks because they have been one of the only asset classes that have beat inflation over the long term. But because they're creators and destroyers of wealth, you also need some bonds and some other investments to diversify and not put all your eggs in one basket. And if you do these things, you will position yourself for greater success. I want to close the session by just talking about an article that was in Kiplinger's Personal Finance magazine. I know you guys don't even read magazines, do you? Online magazines, right. This is an investing success story, and it's about Helen and Jeff Brown. It says that they've built a small fortune thanks to their savvy investing skills. They have several $1 million. And there are several things I took away from this article as I read it. First of all, it said that the Browns don't typically invest in individual stocks. They tend to invest in mutual funds with strong records. Number two, the Browns have also been disciplined savers. Helen says that even right out of college, when she sold computers for IBM, she saved, listen to this, 35% of her take-home pay. Now, that sounds like a lot. That's a pretty good saver, isn't it? I knew people who were buying BMWs and Rolexes, but I kept my savings plan in place by buying my Altima and just living within my means. Today, the couple saves 33% of Jeff's pre-tax pay. Now, understand that that's where they're at today. They weren't always there. But they started somewhere. And they begin to save more and more and more. And it looks like she began at 35%. That's an amazing goal. But what am I trying to say? If they can get there, you can get there. Any of us can get there. The half of America that can't come up with $2,000 for an emergency can get there. And finally, in order to be an investor and to reach your long-term goals, you need to be determined. I love what this t-shirt says. Determination, a fixed purpose, the power and will to persist, resolve, to have the drive, to have the grit, to go the distance, to be hell-bent on reaching a goal and getting it done no matter what. And that is what you have to do when you consider investing. That it's not a want, it's a need. Now we're going to open up for questions in just a moment. I want to share a couple of resources with you for further research. One of them is Morningstar.com. Morningstar.com allows you to subscribe. I believe they have a free level, maybe a paid level. It's definitely worth the money if they charge for it. They actually go through thousands of funds and rank them, and they'll tell you about risk and return. They'll even put a certain number of stars, 5 stars, 4 stars. Those are good funds, according to them. A 1-star fund, they don't like that. And their analysts have already gone through the process of looking into the funds and what they're buying and looking under the hood of the car, so to speak. Another resource is Kiplinger Retirement Calculator. And this is on the Kiplinger.com website. It's a retirement calculator that will allow you to put in your information that's specific to you and when you want to retire, etc. And it will help you determine how much money you need to save to get to that goal. Another research that I just love looking at it is the visual stock market. And it's at www.smartmoney.com/map of the market, and make a special note of the dashes in between map of the market. Basically, this is a resource that shows you what's happening in the stock market today in visual format with green and red. Green will be the stocks that are going up, red stocks that are going down, and various shades of green and red, and also different size squares for different size companies. And then in addition to that, it sections them off into the industries or sectors of the economy. So you can go into an entire sector and look at all the biggest companies in there and see if it's going up or down today and how much. So it's a great place to learn about the stock market and what's going on. 2 more here. Investing news. This is seekingalpha.com. They have some great resources, lots of stories about investments, stocks, bonds, other types of alternative investments. And finally, investing ideas from an organization called betterinvesting.org. All right, I want to open it up for questions now. And there's a microphone right here in the front. Take a moment, think about questions. If you've already had questions, come on down to the microphone. And if you think of them as somebody else is talking, come on down and get behind them. I'd love to answer any and all of your questions. Do you have any questions?
I have one for you.
Go for it.
There's tons of sites out there just for buying stocks. There's E-Trade, and I can't think of any others off the top of my head. Are there any that you would recommend?
I love E-Trade, and I also love Scottrade. Both of those have very low commissions. But basically, if you're going to buy stock, why should you pay a huge commission unless you're getting a lot of investment advice out of it? So if you're not working with a broker or an investment advisor and you're doing it yourself, then you want to pay a very low price, but you need to be aware of what information they're giving you. And some of the investment companies give you a little bit of information. Some of them give you a wide range of tools that you can use. And E-Trade is one of the ones that gives you a lot of the tools that are pretty cool. And so low price, which saves you money as you're buying stock. And especially if you have to sell a stock, because you're going to pay when you buy it and then when you sell it. So you have to think, I'm not just buying it, but whenever I sell it, I'm going to pay also. And these costs can add up over time. So find a discount broker like that and get started in individual stocks. Good question. Any other questions?
So I was reading this article the other day, and it said that the student loan bubble is about to. I've heard this around a lot. That the student loan bubble is about to burst. It's getting nearly to $1 trillion, and that the cost of college is going up, salaries are going down. There's that huge gap that we're gonna pretty much be in a rat race when we get out. I just want to know your thoughts on that and what we should do to prepare ourselves after college, because that's a pretty big hurdle to leap over if we even want to save for retirement too.
Now, are you saying that if the student loan or the debt bubble bursts, that the economy will suffer again and we might have another recession? Is that what you're?
Yeah, I'm not too sure on what they meant by that, but I'm assuming that's probably.
I have read some of those articles, and certainly it appears like a bubble. It looks like a bubble. The real estate market had a bubble in it before 2008. And certainly something is going to happen with that bubble. There's no question about it. However, having said that, I'm one that is a big believer in following what the Federal Reserve is doing and talking about. The Federal Reserve is a central bank, and they control basically the interest rates in our economy. And they came out even as recently as today and said that they're not going to raise the interest rates for a while. And they said that the interest rates, that people should not be concerned about rising interest rates. And so I think maybe part of the concern about the debt bubble bursting is that people are concerned about the rates on those student loans going up. Now, there is one thing that is going on where some of those student loans are supposed to go way up all at once if something isn't done. That's of major concern.
Yeah, I heard that July 1st the interest rate is supposed to double.
If nothing changes, and of course, if you're working for the government, if you're in Congress, it is to your advantage to work something out. And so I believe that people are talking about it. They know about it. They already have a plan for it. We may not know all about it yet. I don't think it's going to be as bad as they say. However, if nothing is done, those rates will go up for a lot of people. And that would change the course of a lot of people's lives. Personally, I think that Congress is going to do something about it. And typically it takes a certain amount of anxiety in the public before Congress can then step in and do things. Because they're representing their own people in all the different districts that they represent, and they don't want to attach themselves to an issue that's not popular. So they'll wait until something is a really big deal, and then they'll jump on the bandwagon and try to fix it and come out looking like heroes. So, good question.
I actually got two questions. The first one is a two-part question, and then I'm going to go into the other question.
Okay.
But, the first question that I have is, could you explain the S&P 500?
Yeah, exactly. Good question.
Because I was reading about it, and it was like, well, why don't you just invest in the S&P 500 to cover those 500 companies that are performing? And so what are your ideas on that?
Well, first of all, there are several stock market averages that I didn't mention in my presentation. The first one is the Dow Jones Industrial Average, and that's probably the most popular. And that has 30 stocks in it. 30 hand-picked stocks. And by the way, they do change this average over time, so it has not stayed the same. If they don't like a company and it's not doing well, they kick it out and put another one in. So it's kind of a rigged game to a certain extent. However, it's watched by millions of people every day. And it's kind of the one that the news people talk about first. But they tend to also talk about the one you mentioned, which was the Standard & Poor's 500 index. And that is an index of the 500 largest companies in America. That's the 500 largest. It's not managed based on if some committee likes it or not. It just happens to be the 500 largest. And the second part of your question was, why don't we just invest in the S&P 500? Well, there are different approaches to investing. There are people that believe that you can beat the market. There are other people that believe that it's impossible to beat the market, that it's very difficult. And so the people that believe that they can beat the market try to find the best performing funds and get a higher return than the S&P 500. It does happen, but it doesn't happen to everyone. And it doesn't happen to all funds. Other people subscribe to what I call the Vanguard method. And a Vanguard is a company that basically just sells index funds. S&P 500 is an index. And it's an index fund is a fund that just tracks the index. So the Vanguard Index 500, all it does is track the S&P 500 with a tiny, tiny bit of cost. Whereas most other mutual funds, where there's a manager buying and selling stocks or bonds or whatever else, moving things around, changing them, the costs are going to be higher. So the Vanguard is a lower cost, kind of put your money in there, let it go, forget about it type of philosophy. Whereas some of the other funds are, hey, it's actively managed, we're hoping to beat the market on this thing. Does that make sense?
Yes.
So it depends on what your perspective is. You can choose either one, and over the long term, the chart I showed you was the S&P 500 index. So if you had not done anything but invest in the index over a long period of time, especially 20-year periods, you will make money.
Thank you. And my next question was, what are your thoughts on penny stocks?
Penny stocks. A lot of people ask me about this, and I just have to say I'm very risk averse when it comes to that. And here's why. A penny stock is one that's has a very, very low share price, right? And because it has a very, very low share price, it tends to be very thinly traded. And also there are a large percentage of those stocks, not all of them, some of them are legitimate. But because they're such small stocks, they're not really followed by the mainstream investing public. So there's less what we call liquidity. There's less buying and selling. If you needed to buy into it, you could actually move the stock a lot by buying into it. So because there's a potential to move that stock up and down a lot, it also creates the potential for a lot of scams. And what happens is people will announce a penny stock on a website or on an email service, and then they'll get all these investors to buy into it, and they will have already bought it, right? And the person that's doing the advertising will then get out, and then eventually when the buyers stop, that penny stock will tank, but the person who started the whole scam will have made a ton of money, a huge percentage. And if you've ever seen the movie Boiler Room, they use penny stocks. So are there some legitimate ones out there? Yes. Could a couple of them become the next big company? Possibly. Could a penny stock return 500%? It's possible. I'm just very, very cautious. So if you wanted to invest in that kind of thing, I would say don't put a lot of money into it. Just be very, very careful. Make it a very small percentage of what you own, because that is a higher risk investment. Make sense? Versus the S&P 500, which is, for stocks, is a pretty average risk. more risky than bonds, but an average risk for stocks. The penny stock is going to be much higher than the S&P 500 on the risk scale. That make sense?
Yes. Thank you.
Good questions.
Hello. I know you mentioned the 401k, but I want to know what's your thoughts on investing in IRAs.
If you don't have a 401k at a company that you work for, the next best thing is an IRA, which means an individual retirement account. And for example, and we call them traditional IRAs, when you get a tax break every time you put money in them. There's another type called the Roth IRA. And the Roth IRA is something where you don't get a tax deduction in the year that you put the money in, but when you take the money out, it's tax-free. Whereas a traditional IRA, you have to pay tax on the money when you retire. Those IRAs are meant for retirement. So that means that they have a time horizon up to age 59 and a half. And so you have to wait up until that point, and if you sell out before then, you're going to have to pay a penalty to the government of 10%. So the IRA is the thing that comes after the 401k as the next best thing, because the 401k will help you lower your taxable income. The IRA is not going to have the same benefits. But the IRA is a retirement investment, and the logic behind it is that when you put money into the IRA, you will not have to pay tax all through those years. Whereas if you went to E-Trade and just opened up a taxable account, then whatever money you earn and whenever you sell it, you're going to have to pay taxes. If you sell it next year, let's say you have 5 stocks and you sell 3 of them by the end of the year because you want to trade them and buy something else. Well, whatever gain you have, you're going to have to pay taxes on that. If it's inside of an IRA and you have a certain amount every year that the government allows you to invest in, whatever stocks you buy and sell over the years, you don't have to pay until you retire. Or if it's a Roth IRA, it's tax-free when you take it out. So IRAs are fantastic, love them, but I'm not a tax advisor, so you always need to consult with a tax advisor to make those kinds of decisions, because you may have other things that you have to pay tax on that affect your IRA situation. So always consult a tax professional before you decide how much and what to put it into.
Thank you.
You're welcome. Any other questions?
Hi. Yeah. I do realize that stock, bonds, and mutual funds is in financial market. Is there any risk difference between investing in financial market between owning a company?
Are you saying the difference between buying a stock and buying the whole market?
No, I mean like investing in the financial market, like stock, bonds, and mutual, rather than like making a company.
Oh, your own company.
Product. Yeah.
Oh, I see what you're saying. That's a great question. So you can go out and buy stocks that are trading on the stock exchanges very easily by buying individual stocks, or you can own your own company and you can build up that company. Well, if you own your own company, you have an interest in that company, right? Mm-hmm. You also know a lot more about that company than you do the stock that you're buying that's somebody else's company. Okay. So for me, the advantage of investing in your own company is that you know a lot more about it. You can control a lot more of the variables that are involved. And so if I had a choice, I would love to invest in my own company over investing in other people's stocks. However, if you invest all of your money in your company, what happens if your company doesn't do well? So now you have what we call security risk, which is easily taken care of by diversifying. So, and this happens sometimes, even when people go to work for a corporation. The corporations sometimes have stock options and stock plans, and they try to get everybody to buy that company stock. And I get that. But you end up, I see a lot of people, and they have in this situation where they have 60% of their money is in their own company stock. And because they love it so much, they don't want to change it. But they're not really diversified. So they're taking a much bigger risk. But at the end of the day, you got to make a decision. So I think maybe balancing the two out. Invest in your own company because you can control more of your destiny. But at the same time, probably hedge your risk by buying some other stocks or mutual funds outside of that. Does that make sense?
All right. Yeah, I also get the second question, which is I'm international students. I've been here for like a month, but the thing is, for my visa, I-20, I'm not allowed to work in here. Is there any regulations or opportunity to invest in stock?
That's an interesting question. I believe you can open up certain types of investment accounts if you sign the right documents. I would call up somebody like E-Trade and ask them that question, or a mutual fund company and ask them the exact same question. I don't know that answer, but in my experience, there are certain forms, depending on the situation you're in, where investors from other companies or countries can invest into an IRA, for example, or just a taxable account over here. You can invest under certain circumstances, but you want to ask the investment company that you're going to deal with, what does it require? So I know I didn't have the exact answer for you, but I think it's best that you go to the investment company and ask them that question.
All right. Thank
you. Great idea. All right.
All right. Thank you.
You're welcome.
One small question. I'm also an international student, and we're just doing a finance class for entering business master, so we're just kind of
great class.
Yes, getting into finance. So I want to ask, like, when you have a company, when do you know when to go public?
When do you know when to go public? Well, going public is always known as a great thing for a company. It gives you credibility. It gives you, it tells the world that you're at a new level, right? Think of it this way. When you think you can get the most money possible for your company, go public. Let's think about it this way. Facebook recently had an IPO. And which means that they were private before, and they became a public company. Do you think that they would try to become a public company if they thought their value was low? No. So basically, the private company owners and their advisors are telling them, hey, we think this is the perfect time for you to go public because we think you can get the maximum price per share in this company, and you can use all this money to expand and do whatever else you want to do. And so this is a good question, not only for yourself, but also for all investors that are on the other side of that equation. Because when a company goes public and becomes an IPO, it's suddenly a new stock on the market. And now they're selling shares in that company, and you can buy those IPOs. And of course, a lot of them tend to go for $10 a share. Facebook, anybody remember what their stock price was when they went public? It was like $30. So they really kicked it up a notch. Of course, shortly thereafter, the stock went down quite a lot. I think it's come back since. But basically, you go public when you think you can get the most money for your company. And but remember, there are some disadvantages as well, and that is that when you go public, you now have to answer to the shareholders. So you instead of just answering to your board or your staff or yourself, you now have this pressure to produce earnings every single quarter. And what does that do? Sometimes it means that instead of going after long-term goals, you become a little bit more short-sighted because you have to produce a profit in the next quarter. Whereas beforehand, you might have had a 5-year plan, something that might not have come through for you for 5 years. So you do have some disadvantages as well. Any other questions? Okay. All right. Looks like there aren't any more questions. I want to say that I've enjoyed presenting to you during this session. I want to thank you for taking your valuable time and investing, pardon the pun, into this series of principles that I know will change your life if you put them into practice. They really will position you for greater success if you know that investing is now a need and not a want. So thank you very much. And if anybody has questions afterwards, you want to come up, I'm going to stay down here for a few minutes. Thank you very much. The presentation will be available soon on Connect under Organizations EBBS Files.